Oh, whoa. All right, so let's we are doing the second half of chapter 7. Now, chapter 7, okay? So we experienced the first half, which was dealing with the purchases. Now, because when we're talking about perpetual inventory, we also know that if we need to constantly be updating our inventory, purchases affect inventory. Well, sales also affect inventory because when we make a sale, we also need to update our inventory and take it out so we have a really good close track record of our inventory. So the second half of chapter 7 is going to be dealing with perpetual sales. Okay? So of course, we talked about the nature of a business, right? The point of most businesses, except for non-for-profit, obviously, their goal is to make money, right? Whether, we take natural resources and we convert that into cash and sell it to consumers. The ultimate goal is that you are trying to make money, okay? So what is going to be entailed with the selling price? Well, it's pretty, you're going to take the cost of goods sold, right? And you're going to add a profit percentage, okay? Meaning you could either double up the percentage or you could charge somebody double the price or triple the price, whatever it is, right? So it has a small section. It's going to be the selling price and then the profit percentage, okay? So, and of course, because if you are selling them in store, we must charge sales tax. Okay, in this class, to keep it really simple, we're going to be using 8.25%. Okay, so let's take a look at this one. All right, so when we are going to be looking at perpetual inventory, okay, here's the first example here, where on June 1st, 10 toys were sold for $9.99 and sales tax was 8.25%. The toys were originally purchased for $5.85, okay, each. All right, record this sale. So, all right, we're in this part right here, when we record the sale, it's just gonna look, it's gonna be very similar to periodic inventory, right? We recognize, okay, we got a sale. That's the first thing you need to recognize when you look at this, okay? We need to record the sale. We received money, we completed a sale, and we have to charge sales tax. That's number one, okay? But under perpetual inventory, there is an additional journal entry we need to enter in, and that is to calculate how much it costs you to sell that item, right? And we need to take it out, we got to take that amount out from inventory because if we sold 10 toys, right? First off, we got to calculate how much did it cost us to sell 10 of those toys. And then we have to take 10 of those toys out from my inventory, okay? So let's go ahead and go through the first section here. Okay? So we're going to be looking at cost of goods sold. So the first thing is going to be, well, how did the customer pay us? In this case, whether they pay us with cash or accounts receivable, right? We're going to recognize sales and we're going to recognize sales tax, right? In this case, we sold 10 toys at $9.99, so therefore $9.90, all right? Plus $8.24 of tax will give you a total of $108.14, okay? Now this is where, okay, this is the selling price that I'm selling to my customers, okay? I'm using $9.99 to sell to my customers, so therefore it contains a profit because this is what it originally cost me. I originally purchased it at $5.85 each toy, okay? So if I sold 10 of them, right, I need to calculate 10 times $5.85 because that's what it cost me. It cost me to sell 10 toys. It cost me $5.85 each toy I sell. So therefore, when I calculate that, right, I'm going to put it underneath my cost of goods sold because this is an expense account, right? It's directly correlated to sales and especially to inventory. So if this is related to inventory, right, this is what it costs me to sell those items, right? And if I calculate 10 times the $5.85, I have to take that amount out from my inventory. And this is how you're going to constantly update your inventory, right? Every purchase you make, you increase your inventory. Every return that you make, you decrease your inventory. Same thing here. Every sale that you make, you're going to decrease your inventory. Okay? For the $58.50, right? 10 times $5.85 gives you $58.50. Okay? So that is the huge difference between perpetual and periodic. Under periodic, we don't care to keep track of our sales. All we care about is just keeping track of what we sold, like in terms of we made a sale, right? But we are not going to keep track of how many items we sell, all right? But where perpetual, right? Because we have the idea of constantly updating our inventory, every time we purchase something, every time we sell something, we need to update it. So at the end of the day, no matter every time we do a journal or we sell something, right, we're going to know how much we have on inventory on hand at all times. Okay? Any questions here? All right.
Teacher,
Yes.
about on June 1st, what first purchase transaction or sales?
We're on sales. That we sold something to a customer, right?
I mean, first purchase and sales second. You mean we have beginning balance of inventory?
Yes, the first half of chapter 7, we dealt with purchases, right? You have to purchase inventory in order to sell it, right?
Yes.
This is the second half of chapter 7. So, yes, you have to make your purchases first, but it doesn't necessarily have to be on June 1st. It could be any day. And then June 1st, we just happen to sell it to a customer.
Yes, thank you.
So first half, we learned about purchasing inventory, and then now second half, we're learning about selling the inventory. All right, but this time, remember, we're keeping a good track record of the inventory. We're watching it, how it comes into the company and it leaves the business, right? So in this case, we're keeping a really good track record by costing out the goods sold and updating our inventory, okay, as we go, right? Cost of goods sold is not something we've never seen before, right? We saw it before in the periodic inventory, right? When we do the ending conversion entry, right? We had to use the cost of goods sold. Well, that's the same idea here, except instead of waiting till the very end of the accounting period to do it, you're doing it as you go. Okay. So, of course, when we sell to our customers, we can also have the possibility of having sales returns and allowances. Okay. So once again, when we sell products to our customers, right, there are many, many reasons why a customer wants to return a product, okay? It could be because it's when they bought it, they found out it was broken, there was a tear in it, it's defective, it doesn't work, or they simply just don't want the product anymore, okay? Or they're just completely unsatisfied. They tried the product, they didn't like it, something happened, and they want to bring it back because they are completely unsatisfied. Okay, it happens, right? But we as a company must hold some kind of company policy to refrain our customers from having them return the product at any given time. Okay, so of course, because our goal is to try to keep our items sold, right? And if we have customers come in and just want to exchange or want to return all the time, then your business is not going to be able to survive because you're never going to get the money that you should be getting. Okay, so in this case, your company must set up some kind of company policy, right? Common ones are, you can return within a certain amount of days, right? Usually it's 15, 30, 60, 90 days. Okay. Or you can only redistribute store credit, so keep the customer from coming back. Okay, so instead of giving them a refund, you just give them a gift card and say, well, here's your store credit for the item that you bought, but it just makes you have to return back to the store and purchase something else. Okay. Other things could be final sale, where you just cannot accept or return anything at all. And then other ones are going to be, you can issue a new product. Okay, some people do that. And last but not least, you could do like exchanges, even exchanges. Okay. But of course, if you charge sales tax at your store, you must also return the sales tax. Okay, based off of how much the merchandise is. So remember, sales tax isn't based on the items that you sell. It's based on the total price of the items that you sell. Okay. So with that, let's go ahead and practice our first section here where we sold something. Okay. So here, example is that on May 1st, okay, you sold 50 coffee mugs for $5 each, okay? And these coffee mugs cost you $1.25 each, okay? Sales tax is 8.25%. Customer A pays with cash, okay, for these mugs, okay? So let's go ahead and record the sales first. So in this case, right, we need to recognize the sales section first, and then we deal with inventory afterwards. Okay, so first off, what is the situation that happened at hand? Well, we sold something. Okay, so how did you get paid? We received cash. So in this case, we're gonna have cash, sales, and sales tax payable, right? So 50 times $5 each. Okay, it's going to give you $250 plus $20.63, giving you a grand total of $270.63. So that's just recognizing what the situation happened in the first place. So you must have a sale happen first before you can take anything out of inventory, right? It makes sense in the real world, right? You don't take out things from inventory if you haven't sold anything. Okay. So then now, once we establish our journal with our sales, right? Next thing we have to do is we need to now calculate how much the cost of goods sold is. So how much does each coffee mug cost me? In this case, the scenario says it cost me $1.25 each. Okay. So therefore, if I sold 50 of them and it cost me $1.25 each, how much is my total cost of goods sold? Well, let me see. If it cost me, right, $1.25, right, and we're going to, so $1.25 times 50 is going to give you $62.50, okay? And of course, you're going to take it out directly from the inventory account. So in this case, my inventory account is coffee mugs. Okay, it's going to come right out of my coffee mugs account. And this is what you have to do every single time you sell perpetual inventory. Okay? All right. So then that was just the sales section. So now let's go ahead and look at scenario number 1, where a couple days later on May 10, customer A wants to return 10 of those coffee mugs, okay, for a full refund, okay? And of course, your company policy was to return within 15 days. So therefore, customer A, right, meets the return policy date. So therefore, the coffee mugs, which originally cost you $1.25 each, right? So let's go ahead and record this return. Okay, so in this case, the account that we're going to use is the same. We're going to use a sales returns and allowances. Okay, we're going to recognize the tax because obviously we charged tax in the first place, so we must give that section back. So always, 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 when we're dealing with perpetual inventory, you want to recognize the sale first. So in this case, we're recognizing that we're returning merchandise. Or in this case, yeah, we're returning merchandise and we're returning the money. Okay, so in this case, sales returns and allowances, okay, and sales tax payable because we originally charged them tax. We have to give them back the tax money, okay, and of course, we have to give them back the cash because that's what they paid in, okay. So now we gotta take a look at this. If it was only 10 mugs, right? What was the originally selling price on that one? It was $5 each. So therefore, your sales returns allowances is $50, right? Sales tax off of $50 is $4.13. So therefore, you will be giving back cash for 54 and 13 cents. Now, because this is a full refund, right? That means the customer is bringing back the product, and therefore you need to also reverse the entry to put back the inventory back into the inventory, right? Now, of course, in real life, you would never put old or used or refurbished inventory in the same whatchamacallit, in the same account as your new inventory. You would create a second account for it so in case you have like a clearance sale, you could put all those refurbished items out there. But in this case, right, you would normally not, put it back into inventory. But for this case and for this class, I just want you to imagine that that's what you do, okay? You're just going to put it back into inventory, right? That's the idea, right? Because we're getting a return, right? They're giving us the product. So what do you do with that? You got to put it back into inventory, right? And this time, because cost of goods sold is one of those flexible accounts, you can increase and decrease cost of goods sold. So in this case, right, you're going to basically undo or reverse the transaction. So you're going to put the items back into inventory and undo the cost of goods sold, because in this case, you never sold the product, right? You're reversing the transaction. So in this case, right, if it cost me $1.25 each, right, and we're returning 10 of them, then you take 10 times $1.25 each, and then it is for $12.50 that you're going to put back into inventory, and you're going to undo the cost of goods sold. Okay? Any questions here?
Teacher,
Go for it.
the price for sell price $5
Correct.
and the cost 1.25.
Uh-huh.
The difference between sell price and cost, it is very big, more than $3.
Okay.
This is different. It is profit margin between 5 and 125.
That's the profit margin, correct.
Okay, thank you.
Okay, so any company, right? If you actually really take a look at it, any company that's a really major, big company, they sell or they purchase their inventory items at dirt cheap prices, and then they charge, especially, to other consumers, right? If you don't know this, the cost of making these items is significantly small. If you if you make thousands at a time, right? You're going to notice that, but that's managerial accounting or cost accounting, right? In this case, right, the product that we bought for coffee mugs, they're significantly dirt cheap. But in real life, right, when we sell it out to the store, you get to choose your price point. But you don't tell your customers, hey, I bought this for $1.25, because they're going to be like, well, why are you charging me $5? No, those kind of things you don't tell people, or you don't tell customers. They don't know that. Okay. But as a consumer, right, you're selling, if they believe that your brand is quality, right, they'll continue coming back to purchase your items, even though they don't know that you actually bought it a lot cheaper. And that's the business, right? I want to make a 200% profit. I don't want to just make double the price. I want a 200% profit. And that's why the profit margin between $5 and $1.25 is so huge, because I want 200% profit. Now, in this case, we are not the profit managers. We are not the sales managers either. So all those numbers that you figure out, those come into cost accounting or managerial accounting. Okay? Those, again, is another higher level of accounting. Right now, all our job is, we see a transaction, we record it, no questions asked. Okay? So there you go. But yes, that $5 compared to $1.25 is the extra profit margin. Okay. All right, so that was a full return. Now, of course, we talked about allowances in this class, right? We have the capabilities as a small business to haggle or to, be able to modify our prices, right? Or offer additional discounts, because as a small business, right, it's a lot harder to obtain our customers, just because, especially a small business, right, no one's going to recognize who we are. They don't really know if our products are good or not. So that's why, we want to give our customers incentives to want to keep coming back. So in this case, right, if on May 18, if customer A wants to return 10 more coffee mugs, right, because they just don't like the color, or in this case, the customer doesn't like the color, okay? And of course, you tell them that the customer has missed the return policy date, right? They went over the 15 days, right? So in this case, they they're trying to return the product, but in this case, they already missed the return policy. And so because they missed it, right, they're still in the store and they're making a commotion, things like that, right? So in order to just, kind of ease the situation, you kindly offer them a 15% discount. Okay? So in this case, how do I record this allowance? I'm not giving their money back 100%, but I am giving them an allowance, partial of the money returned back to them. So how am I going to record this now?
With a sales returns and allowance and sales tax payable in cash.
Good, absolutely correct, right? Because you're giving a small portion of the money back, right? You're only giving 15% of the money back. 15. Now, if each coffee cup, right, once again, was that we sold was $5 each, right? And then we sold 10 of them, right? Now, 10 times 5 is 50. What is 15% of 50? In this case, it's $7.50. But because of that, we also have to give back a portion of the tax back. So we're going to take $7.50 and multiply it by the tax to give you 62 cents back. So in this case, we're going to give the customer $8.12 back. Now in this case, we convinced the customer to keep the product. So because they missed the return policy date, right, and we gave them a 15% discount and they're satisfied, do we need to return the items to our inventory?
No.
No. So there's no need for a second entry here because the product never came back to you. So in this case, that's how you do this one. So sales allowances, right? If you convince the customer to keep the cups, then you don't need to update your inventory at all because they never returned the product to you in the first place. Okay? And any questions here?
No.
Okay. So last section here is going to be section 7.6, where, well, we talked about having a sale. We talked about having a sales returns and allowances, right? Have the customers return the product. And then now the last section is having a sales discount. So once again, depending on the market, the best way to get rid of your products is to have some kind of sale, because we talked about this, right? Consumers would normally, if they don't really know how you are as a company or just a brand as well as a brand itself, they don't know whether your product is good enough. So the best way to entice your customers to come and buy your product, you would most likely have some kind of sale going on, because again, a customer's not willing to spend their dollar. You have to make the product worth it for them to spend the dollar. Now in this case, right, a lot of customers, the very first thing is that they do price checkings, right? They compare versus the online, or if it's the same exact product, they're going to compare prices to see which one's the more cheaper price. Again, so if you have a sale going on, that will definitely pull in your customers to want to buy your product, and you could sell your product a lot quicker when you have these type of sales. So again, it could be a promotional sale, it could be a grand opening, it could be a weekly ad, anything that you have something like that, like a store-wide sale. Or it could be an online order or online deals, okay? Well, we also have another type of discount as well, where if people are paying us on an account, right, we can give them an incentive to give them terms, which basically for a customer standpoint, right, we're telling them, hey, we will give you a discount off the purchases that you've made if you pay me back in time instead of later, right? So let's go ahead and dive into our example here, where we have our sales discount for the in-store, okay? So example here is that on June 1st, okay, your store is having a promotion on all items at the store are 40% off, okay? And of course, and a customer decides to buy 10 of baseball hats, okay, which you originally have the selling price at $10 each, right? But it actually costs you $2.50 to purchase. Okay, so in this case, right, we got sales tax as well. Let's record this transaction. So first thing you gotta do is you gotta recognize what has happened in the first place. So in this case, a sale has happened. Okay, you sold 10 hats at $10 each, okay, original price, but because there's a store-wide sale going on, you also need to calculate what 40% of that. So in this case, when you actually collect the money, you're actually collecting significantly less, right? So if you remember, this is the same, right? You're going to recognize how you got paid, number one, 2, you're going to take a discount off of the selling price. And then 3, you're going to recognize sales. And last but not least, sales tax payable, right? You still got to charge tax no matter what. So in this case, right, we take a look at sales first. We're going to charge the sales based on the original price. So 10 times 10 is 100, right? $100. But the sales discount here is telling me that it is 40%. So therefore, I'm going to take $40 off. So therefore, the customer owes me $60. Now, of course, they don't just owe me $60. They owe me tax on top of $60. So you're going to take your $60, you're going to multiply it by the tax, and then you're going to get your total amount here to be $64.95. Okay? So that's how we calculate discounted prices, right? We don't take the price and discount it right in the very beginning and then figure the numbers out that way. Okay? Because in this case, right, when we're looking at a sales discount, that is exactly what you see on the receipt. Okay, you will see that a sales happened, you will see sales tax, and you will see you would see the discount, excuse me. Okay. So, yes. So now that we did that, right, we also need to calculate how much it costs us to sell the products. Now, in this case, if it costs us $2.50, then we can get rid of our inventory $25, right? 10 times $2.50 gives you $25. Okay, everyone okay here? Everyone good? Any questions?
Yes, teacher.
Yes.
About sales tax payable,
Okay.
you accounted it from the 64.95. Why you don't from the 100?
Because you didn't sell $100. You only sold $60. Because you got a discount, right? You cannot charge
Yes.
you cannot charge. So the rule about sales tax is you can only charge the customers on what they leave the store with. So in this case, did they leave the store with $100? No, we discounted that price. They left the store with $60. So in this case, we can only charge tax based on what the customer purchases from us.
My question depends on you discount from 100 and sales tax payable after discount, not before discount.
You never ever tax before discount.
Thank you.
Right? You can never discount tax. So that's why you always do the discount first and then tax falls afterwards. Okay? All right? So then what happens if we decide to give customers terms? Okay, so in this case, another separate scenario here where on July 1st, a customer, okay, decides to buy in bulk 100 baseball hats, which originally priced, once again, was $10 each, okay? And because they purchased in bulk from you, okay, we kindly said that, hey, if you put it on an account, we can offer you we can give you some terms, where the terms is 5% if you pay within 15 days. If not, the whole thing is due in 30, okay? And each hat was sold for $10 each. And of course, sales tax is 8.25%. And again, there was a delivery charge for $10. And each hat cost you $2.50 each, okay? So how am I going to record this, right? Since this person is purchasing it on an account, right, we have to recognize accounts receivable. However, everything, we don't apply the discount yet. Because in this case, right, we're going to be using gross method where there's a condition. The condition must be met where they must pay for it before you can calculate a discount. right? So we're going to just recognize the sales as usual, right? We're going to recognize that there's an accounts receivable, right? The sales is that we sold 100 baseball hats for $10 each, which gives you $1,000. Okay, tax on the $1,000 is going to be 82.50. Okay, plus $10 because this time, right? You cannot tax on delivery. So in this case, here you go. We charge the delivery charge very last, and that gives you a total of $1,092.50. Okay. So that is us charging the customer. Now, in this case, we gave them terms. 5% if they pay within 15 days. If not, the whole thing is due in 30. So let's say we fast forward and see what it's like for them to do that. Now, in this case, because we recognize that we sold something, right? And in this case, we're going to deliver it to them. We're going to make sure that we also enter in the cost of goods sold, because in this case, right, every time you sell a product, right, you definitely want to keep a track record that you sold 100 items. So cost of goods sold and inventory, right, in this case, it's hats, right? If it costs us $2.50 per hat and we sold 100 of them, you're looking at $250 worth of inventory that you sold already. Okay. So then let's take a look here. What happens if, let's say, fast forward, it is now July 12th, and then the customer decides to pay for what they purchased, right, in full, okay? So in this case, it is now June 12th, right? The discount period is 15 days. If they purchased it on July 1st, right, fast forward 12 days later, they met the discount period. So in this case, we need to calculate our discount of 5% off of the original selling price. So in this case, right, first thing you should recognize is, what do you owe? Or what does this customer owe you, right? So you know what your starting point is. Most oftentimes what you need or should do is you may need a reference point or look back at the sales receipt so you know how much to calculate the discount for, okay? So in this case, right, for this scenario here, right, we're going to be giving them a discount because they met the discount period. So first thing that we're going to do is we're going to be receiving money from them, okay? Then we're going to recognize, okay, well, they met the discount, so we must give them the discount. And because we already charged sales tax, we also have to give a portion of the sales tax money back because we already charged them. So therefore, then we calculate from there. So in this case, right, first thing we're going to recognize is how much does the customer owe me. In this case, they owe me a total of $1,092.50, okay? Now, if we take a look at what the total sales include, right, it includes $10 of delivery charges and $92.50 worth of tax. Once again, you cannot discount any of these items because that's not how discounts work. They only discount you on the original selling price. So in this case, right, if every, right, that you can only discount off of the original selling price. So therefore, because we're going to be taking a look at 1,000 because we sold 100 hats at $10 each, right? That was the original selling price. We're going to take the 5% discount off of the $1,000. So that's going to leave us $50, and then we're going to take the tax off of $50, which is $4.13. So therefore, when I calculate how much the grand total is that the customer should be paying me should be $1038.50. Okay, any questions here? Okay. Now, because it's a sales discount, right? Do we need to update our inventory?
No.
No, because we sold the product, right? There's no return, no allowances, nothing's coming back to the thing. We're just taking a discount off of the selling price, not the purchase price. So in this case, you don't need an extra journal because you're just recording that the customer is paying for what they owe. That's it, simple. Okay? So therefore, chapter review, we talked about sales, what happens when you have perpetual inventory and you deal with sales. Okay, this time the difference is you have two journals you need to do. One to record the sale and one to record the update of inventory. Okay, and then of course we talked about what it means to have a returns and allowances and what it means to give discounts, whether it's in store or it's in person. Okay, so let's go ahead and dive right into our chapter 7.4 through 7.6 exercise. Okay, so here we go. So here, number 1 says journalize. Assume that sales tax is 8.25%, and you purchase a total of 500 cups with all costs equaling $1.36 each. Okay. All right. So let's go ahead and take a look at the scenario. So this is where we already purchased the inventory item, right? It was, so we bought a total of 500 cups. It's already been purchased. So in this case, we calculated what the cost of goods sold is, or per item, right? The cost per item. In this case, it's $1.36 each. So let's go ahead and take a look at our scenario here. Okay. On April 5th, we sold 100 cups at $5 each, all right, to customer A for cash. So how do we record this? Oh, let me grab a different one. Okay. So let's go ahead and record the very first transaction here. So if on April 5th, we sold 100 cups at $5 each to customer A for cash, how am I going to journalize this?
Cash, sales tax payable.
Good, right? We're recognizing that we're going to be receiving cash and we have made a sale and we have to charge sales tax. Okay? So in this case, right, how do I calculate this? What was my total sales if I sold 100 cups at $5 each?
500.
500, okay? What is my tax off of the $500?
42.5.
42.5, right? So then how much cash am I going to be receiving?
Yes.
Okay, $542.50. And I'm going to make a note here saying that I sold 100 cups to customer A, okay? There's a reason why I need to do this because what if customer A comes back and returns the item to you? Then at least you know, okay, this is from customer A, right? But if it's just a general population where you don't really know who you're selling it to, then you don't need to make a note. You just need to make a note that you sold to just the general public. Okay? All right,
I have a quick question.
go for it.
How did you get 42.50?
What's the tax?
Yeah, how did you?
Oh, it should be 41.25.
Okay. All right.
Yeah, because I realized that's right. It should be 41.25. 42.50, he rounded. Okay, so tax is going to be based off of $500, right? Which should be 5, 4, 1, 2, 5. I think that's the tax. Okay, so in this case, right, it's going to be just for $41.25. Let me double check that. Okay. Yeah, $41.25. Okay. So then, right, because I sold something, right, I need to do what?
Cost of goods sold
Yes,
and I forgot what we
Inventory.
sold.
in inventory. In this case, what kind of items do I have?
Cups.
We have cups, right? So let's see, okay? How much did it cost me per item?
$1.36, which
Mm-hmm.
would be $136.
$136, right? 100, because that's how many items we sold for $1.36 each. So that means it cost me $136 to sell. Okay. Now, this is what you can do too. Instead of, since this is supposed to be in general terms, this is one transaction, right? Or they're from the same transaction. So it's up to you. You can put another no here that you sold, or you could have put this right here instead of putting the description here. You could have attached it down here too. But I'm just gonna go ahead and just also type that in there. Sold 100 cups. Okay. So let's see what happened next on April 7. Okay, you end up selling. So you sold 25 mugs at $5 each to customer B on an account, and you also gave terms of 10%, 15, net 30. So how do I record this sale?
Is it the same? Cash, sales, and sales tax?
But did we receive cash, or how did customer B pay me?
Oh, no.
On account.
It's on an
Accounts
account.
receivable.
Mm-hmm. So in this case, it'd be accounts receivable. But yes, the general idea is the same, except the only difference here is how they paid us. So in this case, customer B owes me money. Okay, so there you go, accounts receivable. But we still have the sales and sales tax, right? Okay. So in this case, right, I sold 25 cups at $5 each to customer B. So how much was my total sales?
125.
$125. How much is tax on top of that?
Is it $10.31? Or are we rounding off?
Yeah, it's 1031.25.
1031.25. So do you round up or do you round down?
You stay.
We stay, right? So so $10.31. Okay. And how much does customer B owe me?
135.31.
Okay. And of course, I'm going to make a note here, right? That you sold 25 cups to customer B. And because you gave them terms, my terms is 5% if he pays within 15 days or he pays the whole thing in 30.
Terms is 10%, is it not?
Is it 10%, 5%, 10? 10%, yeah, good, thank you. Right, we're gonna give them a generous 10%. Okay? Because we sold to customer B, what else do we need to include?
Cost.
Cost of goods sold. So in this case, how much does each cup cost me? $1.36. So if I sold 25 of them, my total cost of goods sold is
$34.
good. So let's see what happened next. Then April 10 rolls around and you end up selling 50 cups at $5 each to customer C, excuse me, for cash. Okay? So you end up selling an additional 50 cups, $5 each to customer C for cash. Right? Says we sold it for cash and it's a sales, we have to charge sales tax, and we sold 50 cups to customer C. Right? So how much? If each cup I sold for $5 each, 5 times 50,
250.
okay? Plus my tax. What's my tax on this?
$20.63.
$20.63, giving me a grand total of $270.63. Okay. And of course, because I end up selling 50 mugs to customer C, I also need to calculate the cost of goods sold for this. Okay. So if it cost me $1.36 per cup times 50, because I sold 50 of them, how much is my total cost of goods sold?
68.
$68. Okay. $68. Okay. So then let's see what happened next. Okay. Then it's April 15 and then customer A decides to return 10 cups for a full refund. Okay. So let's take a look at customer A, right? When did we sell to customer A? We sold to them on April 5th, right? So we sold a total of 100 cups at $5 each, okay? And how did customer A pay me?
Was cash.
They paid with cash. So in this case, if customer A is returning 10 of those coffee mugs for a full refund, how do we journalize this?
sales returns and allowances, sales tax payable, and cash.
Good. Sales returns and allowances. I'm going to put allow for short. Okay. You have to give back a portion of the sales tax because you already charged and collected from them. So you have to give back the money. And then, of course, you had to give back cash. Now, if I originally sold my cups at $5 each and customer A is returning 10 of them, right? He's returning 10 of them. So then how much is my sales returns and allowances going to be for? $50, right? So then how much tax is going to be refunded?
$4.13.
$4.13. Okay, in this case, we always round up when it comes to tax. So then how much cash am I giving back? $54.13. Okay? And of course, you can make a note here too. Yes?
Yes. Effect on the inventory.
Yes, we will we will complete that. Okay? So this one is customer A returns 10 cups full refund. Okay? So therefore, because customer A gave us a full refund, or I'm sorry, we gave customer A a full refund, we need to update our inventory again because we got the items back. So how do I journalize this part?
You put cups and cost of goods sold.
Yes, because we have to undo because we never sold the products if we're returning it, right? So cups
Okay.
and cost of goods sold. Okay? Now in this case, my item still is $1.36 each. So if I have to return 10 of them and put back 10 cups back into inventory, how much is going to be that amount?
1360.
$13.60. Okay, $13.60. Okay? And of course, return 10 cups. Okay? So let's see what happened next. Okay? April 20th rolls around. Customer C returns 25 cups but is willing to take or willing to accept a 15% discount. So in this case, right, I don't know, something happened and customer C decided to return half of the merchandise. In this case, we must have convinced them to keep the cups and offer him a kind 15% discount. So in this case, this is an allowance. So how do I calculate this, or how do I journalize this transaction? If customer C is attempting to return 25 cups, but is willing to accept a 15% discount, how do I journalize that?
Sales returns and allowances, sales tax payable and cash, or not cash.
No, yeah, let me see. Customer C, did they pay in cash? When did we sell to customer C?
Cash.
Yes, we sold to them with cash. Okay, so in this case, same entry as above here. Okay. Okay, so there you go. So how much is going to be the sales returns and allowances? If the customer is attempting to return 25, but we're only giving a 15% discount. Maggie, can you mute your mic? So 25 cups.
$18.75.
Okay, $18.75. So how did you get that?
So they're returning 25 cups and they paid $5 each for them, which equals $125.
Mm-hmm.
And then I times that by the 15% discount.
Good. So $18.75, you said?
Yes.
Okay. So then how much tax do I have to give back to customer C? Because I originally charged them for the full amount, right? I have to give them back their money.
$1.55.
$1.55. So therefore, how much cash am I giving them back?
$20.30.
$20.30. Okay. And I'm going to go ahead and customer B or C returns 25 cups for 15% discount. Okay. So, because customer C is attempting to return 25 cups but is willing to accept a 15% discount, do we need to update our inventory?
No.
No, because we convinced them to keep the cups and just take a 15% discount. So in this case, no need for that extra journal there. Okay. Last thing we have here is that it's April 22nd. Customer B decides to pay his purchases and he meets the discount period. Okay, so in this case, let's take a look at what discount we gave him. So it's, okay, so we sold 25 cups to customer B on an account. We gave terms 10%, 15, net 30. So exactly 15 days because 7 plus 15 gives you exactly 22. So he made the discount period. So therefore, we need to calculate how much 10% is to take off of his original sales price. Okay, so let's go ahead and take a look real quick and glance at the journal that we did on April 7. So here you go, accounts receivable, right? We got sales and sales tax, right? How much was the total sales? Right, it was for $125, right? So I can only discount the actual selling price. I cannot discount tax. So in this case, how much is the discount if it was 10%?
$12.50.
$12.50. So let's go ahead and take a look at this. Okay. It is April 22nd. Okay. So in this case, right, we should be receiving some form of cash or a check, right? Depending on how he paid me. Right? And in this case, right, we have to acknowledge that there's a sales discount because he met the terms. Okay? We also need to recognize that there's a portion of the sales tax money that we have to give back because we originally charged him for the full amount. So in this case, if he's getting discounted, there must be a section of the money that we have to give back because we previously, in the previous transaction, we already charged him the sales tax. So we must give back the sales tax. And last but not least, we need to recognize how much he owes me. Okay. So let's take a look at that transaction one more time to verify how much customer B owes me right now. In this case, customer B owes me a grand total of $135.31. Okay. And we just talked about the discount, right? It was only off of the actual selling price itself. So in this case, we figured out that the discount was $12.50. Now, based off of $12.50, if I'm discounting or taking that amount off, how much tax am I going to be refunding?
$1.03.
$1 and how many cents?
3.
3?
Yeah.
Okay. So then how much cash am I going to be receiving?
$121.96 or 97 cents.
How much?
121
121
and 97 cents.
97 cents. Okay. Okay. And we're gonna 121. I got a different number. 121. Let me see. What's 53 minus 100? That should give you 47. Hold on, let's do this again. So 1. Oh, wait. It's not 135. It's 135.31. Right? Let me see. 135.31. Yeah, so we're looking at 135.31. Okay, 135.31, subtract $12.50, and then subtract additional $1.03. So calculation is I got 121.78. Anybody else got the same answer?
Yeah.
Okay, because our debits and credits must match on both sides. All right, so then, right, we're going to say customer B paid in full, received 10% discount. Okay, and that is it. Any questions in regards to chapter 7.4 through 7.6?
No.
Okay, all right.
I am a little confused
Okay, okay, go ahead, go for it.
on the last one.
Mhm.
On, um, because I thought we give them the discount on the price that they paid for the cups minus the tax.
Right, so let's go take a look at the sales, okay? So here for this is customer B, right? How much did we sell to customer B, right? So this is what they owe me, right? 135.31, right? But we can't discount tax. So therefore, we can only discount $125, right?
Right.
So 125 times 10%, what do you get?
Okay.
12.50, right?
150. Yeah.
So that's the discount off of the sales price.
I guess I was confused because I was just looking at the 135.31.
Okay. Okay, so you can't discount tax. You can't take the whole entire 135.31 and calculate the discount off of that. You can only do for what the selling price was.
Okay.
Mm-hmm. And here, because we charged him sales tax previously, right? We charged him for the full amount, but he's receiving a discount, so we have to give a portion of the money back for the tax that we charged him, which was $1.03.
And that's off the sales discount price,
Correct. Correct.
right? Okay.
Mm-hmm.
Okay. All right.
Okay.
I got it.
Okay.
Thank you.
Mm-hmm. All right. Anybody else? Any questions?